There is no way we can buy a house with the cash we have. We need to call bank for a loan.
No, we'll not talk to bank. Let me talk to guy who knows a guy who knows this one guy that will give us loan.
But one guy may break legs if we don't make payment.
Well, yes, but... Okay, we'll call the bank.
Hey, welcome to episode 3 of First Time Home Buying and Selling. I'm Josh Madison, residential real estate broker in the state of Arizona. And today we're going to be looking at the basics of a hard money loan and the basics of traditional bank financing and the different options that go along with that. Plus, we'll look at the down payment money that you'll need to have in mind for the different types of loans. So let's get into it. Let's talk about hard money loans first because they're pretty straightforward. They're basically a cash loan from an individual or private company directly to you at a high interest rate. They want a large down payment from you, and they are for a very short term, maybe just a couple years, usually always less than 10 years. A lot of times these are called investor loans. Because they are used a short term to get in and out of a property, or at least until you can get a property in the condition where it'll pass for a traditional bank finance loan. For a first time buyer, hard money is usually not the way they want to go because it costs so much and it's such a high risk loan. If you happen to default or have anything happen, you're going to lose the property to this hard money lender. So most first-time buyers prefer to go through traditional bank financing. So if you're looking into bank financing, here are the first steps that you would take to get the process started. So you could start with your own bank that you currently use and find out if you can speak to a loan officer that works in there. Or you can decide to look up a mortgage broker for a mortgage company in your area. Basically, they both do the same thing. Loan officer or mortgage broker both work for the banks, finding you a loan that works best for you. The loan officer at the bank you use sets up the loan for that bank, and a mortgage broker sets up loans for all the banks out there and whoever will fit your needs best. So they both pretty much do the same thing. So we'll call them mortgage brokers at this point because they both set up these loans for a fee. So basically, you speak with the mortgage broker at the lending institution of your choice. At this point, it will be good to have gone over how much you currently pay compared to how much you currently earn per month and year. That's what I spoke about in the previous episode. And it's a good thing for you to know because you're going to have to pass that information on to this mortgage broker so they can figure out what type of loan you qualify for and what interest rate you can get that will be determined on that information you give them. They'll compare what you make compared to what you spend. And in the mortgage broker world, this is called your debt to income ratio. Your credit score will also show what kind of borrower you are, which will help determine your interest rate. So basically, a mortgage broker can help assist you through the steps to help determine what loan works best for you. So they'll get all your ballpark figures. You can usually give them that information over the phone or email. They can help determine what type of loan you can qualify for and also what kind of down payment ability you have. So this will come into play of how much cash you have or how much cash you have saved, at least, that you are wanting to use. Because different types of loans require different types of down payments. Now, to be clear about your down payment, that money is not used until you are closing on the sale of your house. The last few days when you're signing your papers at the title company to close the deal and you're going to get your keys, that's when your down payment money is used. But how much you have or are going to be using, you have to be able to prove when you are getting the loan. That's why you need to know how much down payment you have or at least are open to use. So with our different types of loans requiring different types of down payments, let's use our $100,000 purchase price example from the previous episode. So first of all, if you had a cash hard money lender, they might require 50% down. it's usually common for them to want at least 50% down payment. So in that situation, you'd obviously need $50,000 saved to qualify for a hard money loan. So let's stick with some typical bank financing that most people use. Let's start with the conventional home loan from the bank. Conventional home loans require anywhere from a 5 to 20% down payment. So in that situation, $5,000 to $20,000, usually depending on your debt to income and your credit score. That's how they will determine how much down payment they are requiring from you after looking over your numbers of what kind of borrower you are. Many first-time homebuyers gravitate towards FHA or VA loans, also called federally insured loans. Typically, they're the lowest required down payment and credit scores needed to qualify. All of these numbers are always subject to change with lending guidelines, but currently, FHA requires a 3.5% down payment, so that's $3,500 using our current $100,000 purchase price example. VA requires 0 down. VA, standing for Veteran Affairs, means that you must be a military veteran to qualify. Now, there's also other programs available for down payment assistance. Usually, the down payment assistance goes along with the FHA loan. Your mortgage broker can point you in a direction for a down payment assistance program, as long as there's one available. Depending on the economy and where bank financing currently is at that time, will depend if there are any down payment assistance programs even available. A word of caution for any down payment assistance or grant programs that you get or qualify for. Make sure you understand the rules and the fine print if any of that down payment assistance money has to be paid back within a certain amount of time, or if you sell the home within a certain amount of time, it has to be paid back or is a penalty against you. Otherwise, yes, the down payment assistance programs can be great and very helpful for anyone who is short of cash. Just make sure you understand all the rules of the program before you completely subscribe. Down payment assistance program can be great where you don't have to be a veteran to qualify for a 0 down payment as well. You can literally buy a house without spending 1 penny of your own money. That's, of course, if you can negotiate with the seller to pay your closing costs as well. But closing costs? Wait, isn't that the down payment money I use at closing? Nope, not at all. Closing costs are totally separate fees charged with creating the loan and part of the sales process. We will dive deeper into what closing costs are in a later episode. But for now, let's wrap up our basic home loans. Depending on what type of loan you go for or what type you qualify for, it's important to find out from your mortgage broker what kind of home purchase it will cover. For example, let's say you're looking at beat up foreclosed homes that need a bunch of fix-up before you can move in. They can be a great buy because they're usually at a majorly reduced price. The catch is, your typical conventional FHA, VA loan won't be approved because of the condition. So you need to look at homes that are more or less move-in ready. Otherwise, you're probably looking at the hard money cash loan for the fixer-upper properties. Also, if the properties are located in floodplains or have well agreements for water, some of these loans won't be approved for that either. I know currently FHA has some restrictions on well agreements for water and floodplain as well. The same goes for manufactured homes on land. There are special requirements that you should find out from your lender on that. Most of the traditional bank financing loans qualify for manufactured homes on land. They will also have some special requirements that you'll need to have in mind before you go out looking or make any offers that you'll want to know first. A quick example of the manufactured home loan and why I keep saying manufactured homes on land is because if you go buy a manufactured home from the dealership, just like if you bought a new car from a car dealership, it's actually considered personal property and it has a title to it, just like a vehicle, just like a car does. Once it is affixed onto land and made part of the real estate, that's when it can qualify for a real estate loan, a traditional bank finance loan that's part of the real estate. So that's what I mean as an example of some of the special requirements you'll need to know when it comes to manufactured homes. You can get those loans, but you just need to know what passes for those loans and what doesn't. and a good realtor will be able to help you out with that. I know this can sound a little overwhelming at this point, but if you have a good realtor and a good lender or mortgage broker, they will help make this process a lot smoother. That's why it's great to keep in mind, what's your why? To sum up episode 3, we've looked at the basics of a hard money loan and the basics of traditional bank financing and the options that go with it. Also, the down payment money you'll need to have in mind for these different types of loans. In the next episode, we'll look at your interest rate, why you should care what it is, and how it affects your payment. Hey, thanks for joining me in episode 3. If you have any comments, questions, or anything you'd like me to cover in future episodes, I left the link to my website in the description below. Otherwise, I will be talking to you in the next episode where we will be interested in interest. Thanks.